All right. All right. Well, hello, everyone. Thanks for coming, and Warren and Miriam, thanks for inviting me to present here. I really appreciate it. My name is Shane Hadden. I am co-founder of Seats, CEO and co-founder with my tech co-founder, Chad Hurley. I am, as Warren said, I am both a entrepreneur creating Seats, and I've been in the fintech world for about 12 years. And then before that, I was on Wall Street. I also teach at UK. I teach in the finance department. I teach venture finance and financial technology, as well as a couple of other advanced finance classes. So what I want to do today, we're going to talk about a new way of raising capital during COVID-19. That's the title of the talk. Specifically, we're going to talk about the new product that my company Seats is creating, which solves a big problem for businesses generally in raising capital, and especially during the pandemic, as I'll describe. So I'm going to take a while to really lay out the problem. And then I'm going to tell you about Seats and how we're going about solving this problem. And I'll talk a little bit about the company specifically and our business plan, and then finally our go-to-market strategy, our launch plans. So Warren said I have about 40 minutes to talk. I'm not sure that this is a 40-minute presentation. So I definitely am looking for, I'd love to hear you guys' feedback. This is a product that is in development. I'd love to hear feedback, questions for sure. Just, you can put it on the chat. I have the chat here. I'll see it. You can do it in real time or just unmute, as Warren said, and jump in. But I really would, if you have questions as I'm going, please just jump in. Okay, so to start, let me just talk about the problem. So here's a big problem. We have a thesis that there is a major systemic, global, however large you want to think about the problem, is related to business funding. That there are only two options for business funding, and both of them have major problems, and there's not a third alternative, and there needs to be a third alternative. So as everyone on this call is aware, most of the time when businesses raise money, they have these two options, right? They can either borrow money, issuing debt, or they can raise equity. And like I said, both of these are problematic. With debt, companies, especially small businesses and startups, which are our initial target market, it's very dangerous for a startup to borrow money. It's anytime they take on a fixed payment debt obligation with uncertain future cash flows, you're just asking for trouble. And it's not advisable. But a lot of companies do it anyway. But that's something that companies should try to avoid as much as possible when they're young. But their only other alternative really is equity, and equity has a lot of problems in a different area. So equity is, in essence, not really fundraising. It's fundraising, but it's also selling part of your company, right? It's like instead of borrowing money, you go and sell your diamond ring. That's what equity is. You are selling part of the company. So you're getting money, but you're losing control to varying degrees, depending on how much you sell and the terms. But you're going to lose some voting control, and this is something that can be problematic to startups because the startup experience is so fragile. There's a magic to starting a company that if you bring investors in and there's not a good fit, personality fit, you can be that can really kind of just set you off on a wrong path. And for small businesses, a lot of small businesses are family owned. They've been around forever. Bringing in somebody new is just not really an option that is palatable to a lot of folks. So that's a big problem. Equity is also a long-term partnership. It's like getting married almost, right? You're bringing in somebody that you're gonna be with for a long, long time, and so you really have to be careful about who you enter into this partnership with. It's very time-consuming to negotiate, to do due diligence on both sides. For the investor, it's extremely hard to value equity. In reality, I think most people would agree it's impossible to value it. Equity is, a claim on every possible outcome that could ever happen into perpetuity for a company. Nobody knows what the possible outcomes are. So valuing it is kind of a, people generally just throw up their hands when you're talking about early stage, and it's more of a market-based approach. It's what are other companies like this valued for? It's not really trying to get the actual value of the company with some sort of discounted cash flow or something like that. That's not possible. So equity is hard to value. Equity is extremely liquid for the investor. You go into these deals and you're not going to get paid until there's some sort of liquidity event in the future. The company could do really well and you still may not get your money back ever, or at least until there's some sort of liquidity event. Maybe a sale of the company, an IPO, possibly, or they're develop some sort of secondary market in your shares, which really isn't going to happen until you're very large. So investors are pretty well stuck in these investments, and it's kind of equity is just kind of a monolithic, very clumsy instrument, right? You can't customize equity investments very tightly. You can't tailor them as an investor to your particular risk return timing characteristics your preferences. So equity is not great either from the business side or the investor side. There needs to be an alternative. And we're in a pandemic. That's kind of the topic of this conversation is really about fundraising in a pandemic. So let's talk about this. The problems that I just described that are that exist always are exacerbated in a pandemic, right? So uncertainty, business uncertainty, what's going to happen? Nobody knows what's going to happen. The idea that you might borrow money during a pandemic is very, very scary. And what's happening? Well, there's, the government's lending, everybody's lending, even if it's interest-free, that's not a good idea, right? It's like, I think of it as like throwing a rope of fixed length out to a boat that's just bouncing up and down on the open sea. It's going to break. So I would, that's a problem that we're probably going to see come around. The next shoe to drop is even more and more bankruptcies caused by leveraging during this crisis, which is scary. But the need is greater. I mean, companies need money, right? They need money to get through. They haven't had revenue. They need funding. They definitely shouldn't be taking on debt. So what are they going to do? They're going to seek equity somehow, or just go under, just not raise money. Who are they going to get equity from? They can't get equity from the government. That's why the government's lending money. We don't want the government owning companies, right? But that's what equity is. It's owning companies. We don't want banks owning companies. So all they can do is lend. We need a third alternative, and this pandemic is making that very, very clear. Another thing about the practical reality of the pandemic is this idea of not being able to, be near each other makes due diligence very hard. If you can't travel, then that probably makes investing more and more local. It makes it harder to travel to meet startup companies to go and do due diligence. If everything has to be on Zoom, that's just a practical problem that makes the whole equity experience even more problematic. So this is a major problem, and we are trying to solve it with a new alternative. So my background is in structuring and kind of financial engineering. And so we've taken a kind of a financial engineering approach to this. I have a lot of experience in securitization and derivatives and other slicing of cash flows in order to place risk with the best buyer. And so that's kind of the approach that we're taking with this. What we're doing is we are thinking about a company as having in the future a series of revenue that starts at zero today and goes out into infinity. And we're focused on revenue. We say, why don't we just kind of deconstruct the equity instrument into claims on discrete slices of that revenue. So we slice up the revenue, a graphic of it, and we create claims, contractual claims on specific units of revenue. And we've standardized these to $1,000 units. And those are called a seat. We standardize these contracts to create liquidity, to promote liquidity so that any type of business can issue these. And we end up with seats as a third alternative to debt and equity. So now, if you're an issuer, you can borrow money, you can sell part of your company as equity, or you can sell seats as a funding by pre-selling your revenue. Okay, so I'm gonna describe how this works over the next several slides, and then I'd like to take questions to make sure that that we're all on the same page. So what we've done is we're calling it funding 3.0. It's a new era of funding. We have this vision of right now there's debt capital markets, there's equity capital markets in the big investment banks. In the future there will be seats capital markets, or maybe it's called revenue capital. So what a seat is an investment that pays when a specific band of revenue is achieved, right? There is no fixed debt claim. So if you buy $10,000 worth of seats, there's not a claim of $10,000 until the reference revenue is hit. Okay, so businesses don't have the worry about a fixed debt claim. And there is no dilution of vote. These are non-voting securities. Okay, so businesses like them, investors like them, because we have created an infinite number of return possibilities that an investor can achieve in investing in a company. There's nothing like that out there, right? You can pick your spots, anything you want. You want to take a super long shot, do it. You want the next $1,000 revenue, more like a debt claim, you can do that, right? And it's simple. It's very simple. We'll talk more about this, but it's easier to value. It's more liquid. So it's better for investors. Okay, diving down a little bit more. So let's say you're an angel investor and you would normally buy the equity of a company, but you say, no, I want to be more specific about this. I want to buy a seat. I'm not really active in the company. I don't need a vote. I just want to buy a seat. So this graph is kind of showing all the future revenue starting from zero out to perpetuity of a company. Let's say you buy a seat, and all seats are $1,000. You buy a seat at $100,000 of revenue, and you pay $500. What that means is when the company achieves $100,000 of revenue, you get the next 1,000. Okay, so if they never get off the ground and they just fold, then you don't get your 500 back. If they go to the moon and sell to Google for $1 billion, you're only going to get 1,000. The most you'll ever get is 1,000. You're going to get the 1,000 between when they hit 100,000 and 101. That's when you get your 1,000. And the revenue is measured quarterly and paid quarterly. Okay? And the definition of revenue can vary by company. Generally, it's cash basis revenue. And it's based on GAAP. Companies can scope out certain revenue if they want to. They can have, thresholds, only the revenue after a certain amount during the quarter. And there is also a provision that if the company is sold, there's actually revenue created. There's a market of the assets to create revenue in that. So if you want to kind of take a position on early stage revenue, you could do this. So you get double your money if the company gets $100,000 of revenue. Or you could take a more risky position that's going to generate a higher return, possibly. Maybe you, instead of 100,000, maybe it's $1 million. Maybe you buy a seat at $1 million and pay $100. That means you'll have a 10x return if the company hits $1 million. Or maybe you buy the seat at 100 million and you pay 50 cents. So you have a 2,000 times return, right? These are all parts of an equity investment that you're not seeing, right? What we're doing is just pulling it out and saying, you can pick whatever spots you want, okay? As far as, how this works for a issuer, what you do as a company is you create a seats program agreement, and that sets in place all of the terms for all the people that are going to buy seats, right? It defines revenue, whatever covenants are needed, that's all in there. And then when somebody comes along and they buy a seat, they'll sign that agreement as well as a purchase agreement that'll state exactly what seats they're buying. Then the company thinks about, okay, well, I can't sell all my revenue, right? Obviously, because you won't have any cash flow in the future. So you have to be careful about what revenue you sell. You're gonna think about it based on your cash flow needs, your profitability, and you can, like my company, we're selling some seats. Our first seats attach at 100,000. And we're going all the way out to 50 million. We're not going beyond 50 million right now because we think that 50 is kind of our near-ish term target. And we're making sure not to sell any more than 10% in any group. So between 100,000 and 200,000, we're only going to sell 10,000 seats. We think that that's prudent. That's okay. We'll get the 90 of revenue. We'll pay away 10. That's not going to hurt our cash flow. And then when there's so on our platform, companies will list their seats that they have for sale and a price, and investors will see that and buy them pursuant to a private placement, okay? And we're gonna do this, I'll explain later, we're doing this in Kentucky in kind of a crowdfunding type construct where it's gonna be available both to accredited and unaccredited investors, up to $10,000. So the experience for the investor that we're in the process of building is something completely new for private investments. The minimum amounts are much smaller. Each company will set their own minimum amounts, but we're expecting people to invest as little as 1,000, which you can spread your investments around much more easily than with equity. We're going to give a lot of data for investors to track their investments. I'll talk about pricing, but the pricing's a lot easier. The whole experience is going to be, a lot more interesting, and you could call it fun, definitely more simple than typical equity type investing. And so before I go any further, are there any questions about just how these work? I'm gonna next talk about, kind of review the benefits and how we're changing things in more detail. But first I wanna make sure that everybody kind of understands technically how a seat works. Does anybody have any questions? No? All right.
I'm kind of curious though, because I might just be slow. But you say it pays out quarterly, so how exactly does that work? Because if they hit that revenue, that expected revenue, whatever the seed is for, but you say it pays out quarterly. Could you explain a little bit more about what that means?
Sure. So the contract is actually perpetual. So it's if at any time in the future, during the life of this company, if they ever hit 100,000, you'll get the next 1,000. But and then every quarter, the company will report its revenue and its cumulative revenue. So next quarter, you may get a statement that says, okay, the company earned 20,000 in revenue. Okay, and then the next statement you might get is, okay, it earned another 30, so now the cumulative is 50. And then the third quarter, you get a statement, they earned another 100, so now the cumulative is 150. So what happened? That triggered payment to you, right? In the third quarter after you bought it, they hit $100,000 in revenue. And so then they have a certain period of time to make payment to you. Your contract ripened into a debt obligation. They owe you $1,000 at that time. There's within 30 days after the end of the quarter, they owe you $1,000. But the measurement and the payments are quarterly. Does that make sense?
Thank you. Yeah, that definitely makes a lot more sense. Thanks for breaking that down for me.
All right, thank you. I may need to be more specific about that on that one slide.
Nah, thank you.
Anything else? And some people ask why we choose revenue. Revenue is the most easily observed metric. I mean, managers can play with any metric on the income statement, but that's the hardest, we believe, to defer or avoid. Right? It's much harder. Net income is very easily manipulated. Revenue is not. Not that we expect any sort of manipulation, but we want to put in as many safeguards as we can. Okay. And I'll talk about this later when I talk about information transparency, but we want everybody thinking about revenue. Let's go generate revenue. And we focus everybody's attention on revenue. Okay. Again, just jump in if you have any questions while I'm talking about this. But what I'm going to do now is I'm going to go through and just, let me just look at the time. I'm going to go through in a little bit more detail and talk about the benefits and just highlight some more of the benefits. And I have a different blog post on every one of these if you want to dive in more on our website. But this Seats allows investors to pick their spots. We've done surveys with investors, and this is what really kind of hits investors the most, is being able to pick your spots, not having to just buy monolithic, clumsy equity. It's the difference between, like, if you're interested in horses, the difference between buying a horse, participating in some sort of syndicate in a horse, or just, betting on a race, right? Taking a position on a single event is a lot more efficient, and just something that for a lot of people is a lot more attractive than buying the horse. Buying the horse is a pretty clumsy way to, it can have its own joys, if you want to get involved with other aspects of it, but for a lot of investors, they just want to take simple economic positions, and that's what Seats allows for. For the business, owners don't give up control. So for this one, the analogy is, it's the difference between, you're a tree, you're a fruit tree. Strawberries don't grow on trees, but you're a fruit tree, and you could either, sell part of your tree, which isn't a good idea, or you sell your fruit, right? Which one do you want to do? Probably would prefer to sell your fruit if you can, right? You don't want to risk damaging the tree. And again, don't come to the conclusion I have fundamental problem with equity. Equity and equity investors are extremely important, especially active equity investors. Equity is critical to a certain amount of capital of a company. You have to have equity. I'm not saying we don't need equity. I'm just suggesting that we probably have too much equity. That equity, a lot of that equity, especially from passive investors, would be better in a different form, which is seats. Okay, there's a question here from George. Thank you. What happens to my seat if the company sells before they hit my seat's revenue mark? Yes, that was a big structuring question early on, and we wanted to structure this so that the investor would get the benefit of a sale, right? We wanted to feel like an equity investment. And so what we did, George, is we put in the definition of revenue. So the definition of revenue is based on GAAP accounting. And what we say is if there is a business combination, meaning if the company sells, then there is a marking to market of the assets. Okay, so if a company sells for 100 million and there's no debt, then the assets are worth 100 million, roughly, right? So all of those assets are marked to market, and that generates revenue. So if the assets all have a basis of a zero, then there's $100 million of revenue at that point, which flows through the seats. So if you had a seat at 80 million, then that would pay. Okay, that's how we've addressed that. So same thing would happen on the other end. If it's a liquidation, then there's this deemed mark to market. Okay, it's not absolutely identical to an equity outcome, but it's pretty similar. Does that work, George?
It does, actually. And I'm sorry, I got so many questions because it seems like a really interesting thing, and I'm still trying to understand how some of this works, but it seems very interesting. So are there any regulations for unaccredited investors? I know there can be a lot of legal mumbo jumbo in terms of getting people who don't have some of their series. I think it's like 63, 60, whatever, can't even remember. But for investing in private companies, because in case they get burned, they might be able to sue or you take some legal action. So is there any regulation around unaccredited investors for these private investments?
So from a regulatory perspective, I'll go ahead and talk about this. We're only going to be operating in Kentucky initially. We're applying for a broker-dealer license in Kentucky. Our companies are going to, we're going to structure these to qualify for an exemption into securities registration in Kentucky. We're only going to cater to Kentucky companies and Kentucky investors, and the exemption that we are using provides that non-accredited investors can spend up to $10,000 for each issuer, and accredited investors can buy as much as they want. But we are fully licensing ourselves as a broker dealer, and these issuances of securities will be obviously fully compliant, but the exemption, if you always need an exemption to registration requirements, whether you're doing it intrastate or federally, you need an exemption. The exemption we're using makes it possible. There's a lot of requirements. There's a requirement for an offering statement, notification to the Commissioner of the Kentucky Department of Financial Institutions, regular reporting, all of this stuff. We're gonna structure our deals to meet those exemption requirements so that non-accredited investors can buy. Our largest market is going to be accredited investors, the typical kind of angel market, but we do want it usable by folks that can, where it's suitable, right? People that can afford to lose all their money, because these can be very, very risky. But at the same time, we want to open it up to, sophisticated non-accredited investors who can afford to lose, $1,000. Okay. So there's owners don't give up control, which is a big, big deal. Okay, I've mentioned this before. Let me talk a little bit more about this. Equity is impossible to value. I teach business valuation. I've been doing valuation of every type of financial instrument you can imagine for a long time. It's just kind of, it's not the case that you can come up with any sort of fair value for an equity instrument with any reasonable, construct. I mean, you can come up with what the market will pay for it, right? You can get a price. There's always a price if there's a trade, but this idea of coming up with some sort of what should the value be, as those of y'all that are involved in funding startups know, that's not really the exercise. It's more what's normally, what is the value of a seed stage company in maybe 2.5, 3 million. So if it can raise money at seed stage, that's probably going to be the value, right? There's not a lot of thought into actually what the value is, right? Because you can't. When you buy equity, you are the asset that you're buying is the present value of streams of cash flow in the future that are beyond, have infinite number of possible outcomes, right? We can talk about shortcuts to try to value it and all this stuff, but if we're being serious, we all know that you just can't do it. But wouldn't it be nice if there was a more simple instrument, right, that we could do? That was risky, but still could be valued more easily. That's what these are. These are discrete events. Everyone is unique. Every seed is unique. $1,000. You're going to get $1,000 if the company does this. That's it. And so all you got to think about is the probability of the company doing that and when they might do it. Right? What's the probability of the company hitting this revenue, and when might they hit it? That might still be difficult if it's pretty speculative. It's still difficult, but it's a lot easier than somehow thinking about every possible outcome of it. And there's another element of this that is just super cool, which is there is a relationship between every seat. Every seat is unique, but they are tied together with a relative value relationship, right? Any seat that is a seat at 100,000 has to cost more than a seat at 1 million, which has to cost more than a seat at 100 million. And the degree to which the price is different is based on the conditional probability of, okay, if you hit 100,000, then what's the probability of hitting 1 million, right? And like the keys on a piano, right, that if they get out of tune, you can hear them, right? Because every key has to have a relationship to the other keys. I'm not a musician, so I can't speak about this too much, but there is this idea of a string of, or a ladder of notes that have to have the right relationship between them. And if they get out of whack, you know it. That's what seats is that's what you can do with seats. Once there's a market that develops in seats, all these prices have to have a certain relationship. And if they don't, they'll be buying and selling to lock them back into place. That, and if you're familiar with, interest rate, forecasting and bootstrapping a yield curve, similar to that, okay? Which is completely new and unique. I mean, it's a little bit like option pricing for equities, but it's also different. Every one of these is going to be unique. So that's really, really nice and I think refreshing in the private equity markets. Even in the public markets, this is going to be, very, very healthy addition. Okay, another thing that seats have relative to equity is better information. There's this idea of the market for lemons, which is basically, it's like a car, at a car lot, the car dealer knows, or somebody else, the seller, the car dealer, knows a lot more about the car than you do. And there's this information asymmetry. And so what are you going to do? You're going to discount what you pay for the car because you know that you don't know what the seller knows, right? And so you're going to discount it. That's a market inefficiency. It gets in the way of efficient prices. Well, when you think about equity, there is no bigger market for lemons as far as financial instruments that you can imagine than equity, right? Managers know a lot more about all these potential outcomes than you do as an investor, right? Even if they told you as much as they could, they're still gonna know a lot more just because there's so many potential outcomes, right? And that's a big problem. That gets in the way of an efficient market, which means that it results in higher funding costs for businesses, which means that, you know, the businesses are not going to be as successful, right? The economy suffers because of this problem. Seats solves this problem, or it greatly mitigates it, right? All you need to know is what's the probability of hitting a single revenue event. And there is going to be tremendous, I mentioned, we get everybody thinking about revenue. Seats are all about transparency. Manager, if you want to enter into a seats program as a business, then you are going to be transparent about your business plan, your revenue forecast, because the investors don't have a vote. The only way that they're going to get comfortable with you is over time with experience and transparency, right? So we are greatly reducing this idea of market for limits. Another thing is think about small businesses. Small businesses, and in Kentucky especially, there is an enormous funding problem with small businesses because, they have debt. They probably have too much debt. But still, people say there's not enough debt. There's not enough bank lending for small businesses. We shouldn't be thinking that way, right? We shouldn't be talking about let's lend more to small businesses. That's crazy. But we have to now because the only other option is equity, and there is no equity for small businesses, right? And I'm not talking about startups. I'm talking about small businesses. The reason there's no equity for small businesses is the private equity markets. These large pools of money for private equity, they don't attach. They're not interested unless they could put $10-20 million of investment in, and they don't want to buy a big chunk of your company, maybe 10%. So you're not going to be able to get big chunks of private equity until your market value is maybe $200 million. So you have this huge group of small businesses that is completely hung out to dry because, they have to use debt or they don't want to use debt, and because there's no equity to be had. Because the people that invest in smaller amounts are VCs and angels. VCs and angels want high possible return. What's the potential return of the investment? It needs to be very high because, one, we're taking a lot of risk, but also it takes a while to negotiate an equity investment, right? So most angels, VCs, or all VCs, aren't going to invest in your corner store. They're not going to invest in restaurants. They're not going to invest in construction companies, right? These aren't companies that present possible, stratospheric growth potential, right? And so they don't get funded. Seats solves that problem, right? It's not a big deal. You don't have to spend a lot of money, thinking about a seats investment. And so potential returns can be higher. Investment amounts are smaller. And you can buy seats just sitting in your computer in small amounts. So yeah, if you can get a good return, I have a beep going off somewhere in my house. Sorry about that. So it enables small business funding. Imagine if you were to go down to your favorite local restaurant and you see on their, on the glass door, just like you see Visa or MasterCard or something, you see a Seats logo. And that means that you can go home, and if you wanted to, you could invest in their company. You could buy seats of that restaurant. And if you want to, with Seats, what Seats allow you to do is to take a very risky position on a very kind of boring company, right? You can carve out a very, very high returning position in a barbershop, right? You just pick revenue that is beyond their base case. You pick revenue that is their stretch case. And if that happens, you'll get a good return. I have a beep and I don't know where it is. Maybe outside, maybe a truck. Angels. So some of you all might be angels. For angels, when you invest, you're buying things that you don't need. If you're a passive angel, you're buying a vote that you don't need. You're buying, and not only buying, you're paying for it, right? There's no free lunch. You're paying for things that you don't need. Don't do that. You can, with seats, you can invest very targeted just in the outcomes that you want. And then locally, our vision is, and one of our taglines is, invest local, right? With seats, we are going to enable people to invest in small companies all around them in a way that is impossible when you're talking about equity investing. And lastly, the topic of this session, COVID-19, we are, socially distanced. You think about seats, you can invest in seats just sitting at home on your computer, buying a seat. You don't have to go through all the process that you would with an equity investment. So it is very much more pro COVID. Makes it very possible to invest even in a pandemic. So let me just quickly talk about the company. The way we're going to make money is we're going to be an investment bank. We're getting a license in Kentucky to be a broker dealer, so we're going to earn money on placements. We're also going to license our technology to others to use. We're going to service these deals and earn fees there. And in the future, we'll manage investments. I got a question, what percentage does seats get? 7% is what we're going to ask, which is what the crowdfunding platforms like Seed Invest gets, 7%. And there's no, it's 7%, which is higher than 5%, which is kind of a typical commission. We're not going to charge any upfront fee. A lot of these crowdfunding platforms charge an upfront fee. So it's only 7%. And we'll do a lot of work to get all the documents in place and structuring the deal and everything. But if any money is raised, it'll be 7%, which we think is very fair. And then as far as the servicing is 5 basis points a month. So that's a much smaller fee. It's a large market we're going into, so we're excited about potentially, having a lucrative outcome. Initially targeting angels. There's a lot of angel investment today, 23 billion a year, 130 billion in VC funds, and then the total private issuance is 2.9 trillion in the US every year. The reason that we do this, I mentioned I have a background in financial engineering, kind of a specialized expertise in coming up with new products. I've done it for the largest of companies in the world, very complicated structures. We have documents that are copyrighted. We have a patent pending. We have a registered trademark on the name Seats, which we're going to use to support and defend our brand Seats. And also there are network effects. So in investing, it's common for people to kind of centralize around a single product, a single brand, because that maximizes liquidity. So we think we have a real opportunity to have revenue-based financing kind of coalesce around the term Seats with our structure, which would be really exciting. Who pays the 5 basis points? The company. So the investor doesn't pay any of it. The investor we may have investor services, some sort of value-added research or other services for investors, but they don't pay when they buy the seats. All right, this is our team. Like I mentioned, a co-founder, Chad Hurley, one of the top developers in the state. He and I worked together for 10 years, and a ex-student of mine, John Ewing, has joined us. Going to be one of our first sales folks. We've been doing this just for a couple of months. In April, we had our kind of beta platform that we used as kind of a listing service. We did a company did a transaction. We didn't broker it, but the company called Neat Suites did the transaction in May. We had a great article about us in Forbes, and we are going to be launching. Like I said, we are in the process of applying for a broker dealer in Kentucky. We're doing the Launch Blue Accelerator right now. we're launching in Kentucky, to Kentucky only, with this local only kind of positioning. We're trying to educate everybody we can, think about using seats. It's a better way. If you are a passive investor, this is really, a great alternative to using equity. If you're a company that's raising money, definitely please think about us for, not instead of all equity, but as a supplement or complement. We're going to be targeting both startups and small businesses. So it's not just the fast-growing startups, also small businesses. So I hope you all will consider seats, and I really appreciate you taking the time to learn about it today. So I'll open it up now for general questions. Thank you.
Thank you, Shane, for a great presentation. Really appreciate it. I think I'm slowly starting to get the premise on which your company is building. Are there any other questions for Shane?
Shane, has it been difficult to get early adopters? I imagine this is something that people would prefer that other people find out the hard way if it works well.
We have a lot of interest. We're kind of on hold now to actually doing trades until we get our license. We don't want to do anything, until we're licensed. We don't want any more seats transactions to be done. But we've gotten a lot of interest. There are a lot of folks that are ready to do it. Like I said, we have one company, other than ourselves, we have one company that has done a seat, and they want to do more. They're chopping at the bit to do more. We actually have some people that have reserved to buy seats in that company, need suites. But we can't do anything until we're licensed. As far as what might happen, I don't know that, every new product is risky, and we want to make sure that everybody understands that, the ultimate payoff, the ultimate success of any of these investment products is going to be the underlying issuer. Over a long period of time, we'll be able to compare it probably, in some way to equity type returns, if there's any sort of excess return that you can get from a seat, and I definitely think you will be able to. But you're right. The pioneers of seats will be taking this kind of risk of are they getting excess returns? Are they getting a better return than they would have if they had invested in equity? I suspect that that they're going to the pricing is going to favor investors early on, because they're going to be fairly, conservative. They're going to go in slowly. But I believe there is so much room, there's so much value that we're creating that the market will still clear. Even if the investors kind of require a really attractive return, there's going to be issuers, because the value to the issuers are, equally as large. So, but we are, what we're doing now is taking indications of interest. So if anybody on this call, if you are interested in kind of getting on a waiting list to say, hey, once you launch and you have several, Kentucky companies on here, I'd love to try this out for $1,000. We're trying to get a bunch of customer feedback and customer, sentiment and positive and negative, to help us, tell the story to others and talk to investors and that kind of thing. So if you're interested in this, please go on our site and sign up, shoot me an email. Or if you're an issuer and you want to just list on our platform now, and then we can start working on, building out the platform for you, please let me know. So what time frame for licensing? So our strategy is we're going to be a broker dealer in Kentucky, hopefully get a lot of press. We've already had national press. This is a national level type of thing. But we have to protect our brand. So we are going to license it to selected broker dealers outside of Kentucky, or possibly investment funds outside of Kentucky, probably for free initially. And then over time, we might charge for it.
So I want to thank Shane again for a great presentation. We really appreciate the time that he's taken. And want to remind everybody, this is the first of our Lunch and Learns. We have 3, and the next one will be on October the 7th, featuring Kevin Richardson, one of our past boot camp team participants. So with that, I think we'll close our Lunch and Learn. Everybody have a good day. Thank you again for attending, and let's stay safe.